Welcome to Growth Investing Mastery. This video will look at our thoughts on multibaggers. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to understand the concept behind multibaggers. We will explain why it's often a misapplied concept that breeds superstition. And the channel Growth Investing Mastery is focused on getting the best results. As of our last portfolio update, our year-to-date returns are plus 136%. And since the start of 2024, our portfolio is up 481%. Let's now talk about the definition of a multibagger. The term originated from Peter Lynch on his book called One Up on Wall Street. And the easiest way to understand this concept is through example. So if somebody says they got a 10-bagger on a stock, it means they got a 1,000% return. And likewise, if somebody got a 3-bagger on a stock, it means they got a 300% return. And the idea itself is pretty solid. Here's what Peter Lynch said about multibaggers. The fast growers. These are among my favorite investments. Small, aggressive new enterprises. They grow at 20 to 25% a year. If you choose wisely, this is the land of the 10 to 40 baggers and even the 200 baggers. So right here, his strategy sounds pretty similar to us. We're looking for companies which are growing aggressively or accelerating. And typically this channel is looking for companies that are growing revenue above 40% per year. This is something that's a bit different than when Peter Lynch wrote his book and the market currently. Right now, it's a lot easier to find companies growing above 40% as the technology has changed. But back in Peter Lynch's day, a 25% grower was considered pretty fast for a growth stock. My main critique of Peter Lynch's concept here is there was no timeline specified for these types of returns. So are we talking about getting a 10-bagger over 10 years or getting a 10-bagger in 2 years? That part's not really specified, and we'll try and define that timeline a bit more. Let's now talk about how the concept of multibaggers gets turned into misapplied advice. And I made a common mistake when investing previously regarding multibaggers. The big mistake was I valued the round numbers of multibaggers. Here's a real-life example. My Facebook shares were approaching a 10-bagger, or a 1,000% return, and I was waiting until they got there to declare the investment a resounding success. And here's two logical flaws with how I was previously thinking about this concept. The first is that 900% returns on a stock is not that much different than 1,000% returns. And going from 900% returns to 1,000% returns on a stock is a small percentage increase. The second logical flaw here is the superstition around round numbers and adding an extra digit of percentage returns. In my example, I was waiting until I had 4 digits of percentage return until I could think of it as a big success. Let's now talk about one more misapplied concept, which often goes in tandem with multibaggers. This concept is let your winners ride, and you'll hear a lot of people say that, let your winners ride. This can end up being a really costly mistake if you misapply this advice. And the reason I know that is because I used to make this mistake as well. The let your winners ride statement needs a big caveat attached to it. I would change the phrase to let your winners ride as long as they deliver phenomenal quarterly results. My mistake here was if I had a company go up over 200%, I felt like I had some obligation to the company. This company made me a lot of money after all, so why would I want to sell them? The ending result was I gave companies way too much leniency in their results. Eventually, one of my big winners would post a poor quarterly result. And I made the mistake thinking, let's give the winner a chance to get back on track here. Now let's look at the corrections to make to this flawed philosophy. A company which has lost momentum rarely gets back on track next quarter. And you can think of this as similar to the law of inertia, where if a rolling ball hits a wall, it goes back the other way. And we could be waiting a long time for the business or industry to recover. One part of my strategy, which I underestimated, was that my strategy for finding winners was really solid. But the problem was that I was just holding companies too long after they had a big run up. I needed to fix the costly mistake of not selling on poor earnings reports. And the big takeaway is we owe the companies nothing at all. There should be no loyalty in this game. Let's now take a look at the correct adjustments to make to our previously flawed strategy. And our big epiphany moment happened when we read Saul's knowledge base in 2020. We understood we're making a mistake in our philosophy regarding multibaggers and let your winners run. I'll also add that one of the most challenging things to do as an investor is admit when we were wrong. If the mistake is related to our overall strategy, it can mean we are compounding a mistake for years or even decades. Getting into what Saul said, here's what he wrote about multibaggers. I pay no attention to 2-baggers, 5-baggers, 10-baggers, etc. in individual stocks, nor do I count them in considering investments. This is relevant because this way it never crosses my mind to think anything like, this stock is slowing down, but it's a 9-bagger. Maybe I should hold it for another year to try for another 10-bagger. Going from a 9-bagger to a 10-bagger is only an 11% gain. And I'll pause for a second now to add my own commentary here. And if you remember from the earlier slides, I was making this exact mistake that Saul talks about. I had Facebook shares at a 9-bagger, and I was waiting for them to become a 10-bagger. I wasn't even considering trimming or selling any shares until they got to be a 10-bagger. And that's part of the reason Saul's words hit so strongly, because I was making the exact mistake he was talking about. Continuing on, Saul said, if I'm no longer in love with the stock, I should be able to put the money into a new stock that will be up 30% in a year, and it will never even cross my mind that I missed having a 10-bagger. Here's another way to think about it. If you have an 80-bagger on a stock that grows to an 85-bagger, it sounds exciting, but it's only a 6% gain on your money. If you take the same money and put it into a new stock where you just get a tiny little 2-bagger, you've made a 100% gain on the same money. Which is why I don't pay attention to trying to get multi-baggers. If they happen, fine, but it's not my focus. Going back to my strategy, I was previously focused on getting multi-baggers, as I took what Peter Lynch said literally. Continuing on, Saul said if you were to put a small amount of money in every stock listed on the market, you would eventually pick up every 10-bagger, even every 100-bagger that occurred. You'd be able to brag, I have 50 10-baggers now, and 3 100-baggers. But so what? You'd just be doing as well as the markets as a whole, by definition, as you'd be investing in the whole market. My goal and my entire focus is increasing the value of my entire portfolio. As I pointed out above, having a multi-bagger on my whole portfolio is what counts, not on individual stocks. And Saul bolded that last part about having a multi-bagger on their portfolio rather than individual stocks. As he points out there, if you want to own every 100-bagger, just buy an index fund. Saul went on to add, not accepting that an investment could be a mistake as it continues to go down is a dangerous error and could be very expensive. A big problem investors have is getting attached to their previous decisions and not being willing to consider that they may have made a mistake. Some of the most angry people I've seen get on these boards is if you criticize a stock that they've fallen in love with. Lastly, Saul added, I try to always pay attention to criticism of a stock, to reevaluate my investments, and to get out if it turns out that I've made a mistake, or if the situation has changed, which is why I rarely end up holding stocks for 5 to 10 years. And the reason I added this full text of Saul's opinion on multibaggers is because I think everything he says here is precisely correct. And that last part is that he doesn't usually hold a stock for 5 to 10 years because companies usually disappoint before then. One of the big takeaways here is that we want to be open to reevaluating our companies. Many of our companies are likely to have disappointing earnings reports at some point, and it's a good idea to sell if there's a real disappointment in the business. Let's now look at some more of the applied logical corrections we want to make to our previously flawed philosophy on multibaggers. We want to keep the idea of finding stocks that can have huge returns in the near term. I put near term in all caps there because that's a very important part of our strategy. And that's really where we differ from Peter Lynch on this idea. We need a defined time frame for when we expect those returns. Our specific timeline looks for a company that can 3x in 1 to 2 years, 10x in 3 years, 30x in 5 years, and 100x in 7 years. The main requirement there is the first one. We want the company to be able to 3x in 1 to 2 years. And the others are a little more optional, but ideally, every one of our companies would be able to 100x in 7 years. And this naturally leads to the question of why 3x? The answer to that is that the bar is too low for just 2xing in a company. That allows in a lot of companies that are just undervalued. We really want to see that the company can triple in the near term. And something really important to note in those 4 steps of going from 3x to 100x is that each leg up is 3x from the previous gains. What this means is that after a company triples in 1 to 2 years, we want the company to be able to triple again. And that works out to roughly 10xing in 3 years. Once the company is 10xed, we want the company to be able to 3x again, which works out to 30x. And likewise, once a company is 30xed, we want to see that they can 3x again to 100x. If we own a company and they 3x, but we think the growth has tapered off, then it's a good time to look for a new opportunity. Another thing we want to look at for all of our companies is to see if we can imagine an individual company making each leg up, getting to 100x returns. So we want to see that they could 3x, then 10x, then 30x, and then 100x in 7 years. And one really key thing here is that predictions past 1 year require the imagination, not estimated financials. I see investors make this mistake all the time. They start looking to project financials out 2, 3, 4, or even 5 years using discounted cash flows. But the issue there is they're trying to predict the future. We don't even know how the business cycle or industry will look 1 year from now. So financial projections beyond that are not helpful. And this is where a lot of investors get caught up. They need to be both objective and subjective. For the immediate time frame, we want to focus on objectivity. What did the company just report? Did they beat their guidance? What's their upcoming guidance? What's their upcoming guidance for the remainder of the year? But you'll notice that companies never give guidance past 1 year, and there's a reason for this. It's just too unpredictable what can happen. Sometimes companies will have a long-term goal, but it's usually not a strong prediction. So when we go past 1 year for how this stock could play out, we need to turn on our imagination and stop using numbers. Here's an example of how this can work out, imagining each leg up, getting to 100x. Let's take a company like Astera Labs. In the first leg, we can imagine Astera establishing the UA link in the near term. And that may be good enough to get 3x returns in 1 to 2 years. We can see the company getting to 10x returns by building out the hyperscalers' ASIC demands. We can envision Astera getting to 30x returns by dominating the ASIC market for hyperscalers. And we can envision Astera 100xing in 7 years if they're able to reach their ultimate goal, which is to become the mothership of the data center, as they put it. Something to keep in mind is we aren't predicting that Astera is going to 100x. What we're looking for is that they have a pathway to potentially 100x. Getting back to some additional applied logical corrections, we need to forget about if our percentage return is a round number or not. So let's say a stock has 299% return. It's still technically a two bagger, but if it gets to 300% return, we have a three bagger. It should be fairly obvious the difference between 299% returns and 300% returns is practically meaningless. Yet so many investors treat getting to a round number as a huge deal. It's important we root out some of these superstitions in our investing strategy. Otherwise, it hurts our returns, as Saul mentioned. One last key point here is that getting a three bagger, a two bagger, and then a three bagger is a lot bigger return than having a 10 bagger. If we add up that previous sequence of getting a three bagger, two bagger, three bagger, it turns out we got an 18 bagger on our portfolio or money there, and that's versus a 10 bagger stock. Let's now discuss an important concept, which is recovering from missing stocks. Many investors never recover from missing a stock. And one place you can see this is in David Gardner's Rule Breakers and Rule Makers book. And I want to preface this by saying I have a ton of respect for David Gardner, and I learned a lot from this book. I benefited a lot from the Motley Fool platform. But there's certain aspects of the overall Motley Fool strategy that's completely misguided. What David details in the book is he had incredible regret at selling Yahoo as he saw it go on to be a 100 bagger. And his logical conclusion from this was that he must almost never sell a stock. So if you look at the portfolio that Motley Fool owns, they own over 50 good companies. And good is in quotes there because most people aren't able to really define what good means when they say they own a good company. And this approach of selecting good companies does beat the market. So a lot of investors are just happy to rest their laurels, getting a slightly better return than the market by picking good companies. One of the more frustrating things is I've listened to a lot of content from David Gardner, and he's been on podcasts a bunch. And I've even heard other people question his philosophy of never selling. Someone once asked him, why don't you just sell if the business underperforms? And he decided, nope, I'm just not going to sell no matter what. So what would be the appropriate logical correction to this situation? Another takeaway would be to do the mental game work to dissipate emotions from past mistakes. And this approach is recommended by Mark Douglas in his two psychology books. But unfortunately at the Motley Fool, there's really no mention of mental game or how to handle anything psychological related to investing. And I see that as a massive oversight on their part because so many investors struggle with the psychology of investing. So what's a better approach here? And we want to build confidence through building a concentrated portfolio. This allows us to gain confidence in the individual stocks as we get to know them really well. But if we own over 50 stocks, there's no way to follow all those stocks or keep tabs on their earnings reports. Owning over 50 stocks may get us more 100 baggers, but it will lower our overall return. We also want to understand we want a multi-bagger on our whole portfolio, not on individual stocks. And we don't want to focus on getting to round numbers of percentage returns, like a multi-bagger stock strategy does. The final key takeaway is we need to sell a stock when the business underperforms. Otherwise, we underperform. Let's jump into what we mean by getting a multi-bagger portfolio. We want to use Saul's lesson that it's better to get a multi-bagger portfolio than it is to get a multi-bagger stock. The key observation is that getting smaller multi-baggers and then rolling that money into the next multi-bagger provides superior results. And how do we know this? We can compare the results. Saul's long-term 30% plus CAGR returns trounces other investors' returns, including Warren Buffett. And it gets far superior results to the general Motley Fool philosophy of buy and hold good companies. With our own results, we recently had one account get to over 100 bagger returns on the whole portfolio. There's only one account I have which never had money added or removed, and it was a retirement account that I rolled over to do self-managed. That self-managed account started in 2010 and took 15 years to get a 100 bagger on the portfolio. I calculated the CAGR return for that account, and it's 34% over the 15 years. 34% may not sound that crazy on its own, but one example will show how much 34% CAGR is. If we bought a Mag 7 stock like Microsoft at its IPO, it gets about a 30% CAGR return. So our strategy here outperforms the all-in portfolio on one winning stock. What this means is that even if you had a guarantee that Microsoft would be a huge winner from its IPO, you can still outperform this all-in strategy from the Microsoft IPO. Another thing to keep in mind is that our strategy was not comprehensive for a large portion of that time. In 2010, we were making a lot of basic mistakes, as we've detailed in parts of this video. Our improved strategy indicates the theoretical long-term CAGR can be much higher than 34%. One last important point is the rate at which a company can grow in 2025 is higher than in 2010. Companies are able to scale up much faster due to technological advancements. Let's now conclude our thoughts on the concept of multi-baggers. The best advice I can give is to forget the concept of multi-baggers for individual stocks. But we still want to find the best growth names with huge potential. And we understand that getting round numbers regarding returns is pure superstition. Our aim is to maximize our whole portfolio returns, or to get a multi-bagger on our whole portfolio. We realize that buying good companies and holding forever does beat the market. However, just trying to beat the market is a very low bar for us to set. And our strategy at Growth Investing Mastery well outperforms buying just good companies. We reevaluate our companies often, and no company ever gets a free pass from us just because they're a good company. This concludes our video on multi-baggers. I'd be interested for your feedback in the comments section. So let me know what you thought of the video, and as a last reminder, this is not investment advice or recommendations to buy stocks. Thanks.